All right, we are live. We are up and running. This is Frank with the National Real Estate Post. Just want to say welcome to everybody who got here early. Thanks for getting here early. We appreciate that. Just keep in mind, it's about 3 minutes till the top of the hour. And we'll actually get started at about a minute or so after the top of the hour, just to make sure everybody can get logged in. So I'm here with our Senior Vice President from Angel Oak, Tom Hutchins. How are you, Tom?
Doing awesome, Frank. Thank you very much.
Excellent, excellent. And we'll be joined by Barry Habib here shortly as well, if he's not here already. And just want to thank you guys for showing up, and we'll be getting started pretty soon. Again, it's about 2 minutes till the top of the hour, and we'll get started about a minute or so, maybe 2 minutes after the top of the hour. So if any of you have anything to do before we get started, you can go ahead and take care of that now. You can go ahead and do whatever you got to do till we get started. Hey, Barry, how are you?
Great.
Good. We are live, and we are just shooting the breeze here for a little bit until we actually start the presentation. I'm going to start probably about a minute or two after the top of the hour, just so everybody has time to hit the bathroom.
You're going to kind of tell them that you were just waiting for people to log in?
Yes, precisely. So they have ample time to go yell at a processor or, you know.
All right. So, but you haven't actually started the broadcast yet, right?
The broadcast is started. The broadcast is started, and we are live. And
okay, great.
But I'm just letting everybody know we won't actually start presenting anything till a minute or so after the top of the hour.
Okay, well, good.
Yeah.
Good. I'm looking forward to today's talk.
So am I. It's going to be a good one. Yeah, we have a lot of interest in it, so for good reason.
I'm hearing so many individuals in our industry say that the low-hanging fruit is kind of gone. So what can we do in this market to help us overcome some of those things?
Exactly. Yeah. You know, the mortgage industry, it's so interesting. I mean, I got in it in January of 1987. That is 87. So, you know, I've definitely, you know, been through it during the great times and during the tough times. But one thing that's always
you and I used to actually use an abacus to calculate monthly payment. Remember those days?
Yeah, exactly. But one thing about the mortgage industry that's always consistent is you're always going to have those times in the industry where it's just like, man, I'm a great salesperson. Look at my pipeline. I'm making lots of money. I must be awesome. And then all of a sudden it's like, wait a second, maybe I'm not so awesome. You know, maybe I need to try something different, you know, because it's just the way the industry is. So we're right at the top of the hour, everybody. We're at the top of the hour. So to those of you that got here and who are here now, thank you for getting here on time. But we are going to give everybody just a minute or two to get logged in, because sometimes you have to do a little download or something for the go-to system to get plugged in. So we're just kind of shooting the breeze here with Barry Habib and Tom Hutchins. Of course, this is Frank Array with the National Real Estate Post. So we're just kind of hanging out for another minute or two, and then we'll get started. So. Yes, you know, back in the day, Barry, mine and Tom, you're probably the same. I'm not sure when you got in, but it was the HP 12C. That was our Huckleberry. That
was a hot piece to get. Yeah.
Yeah, that was
everybody loved that tool.
Yeah, the HP 12C. You know, you could program those things. I had mine. I was kind of a nerdy guy at the time. Not that I'm not anymore, but it was you could actually program those HP 12Cs to where you could input data like income and debts, right? You could input that in and then push a button. I had my program where I could input data, push a button, and it would pre-qualify the person and it would tell you what their ratios were. You could do that on HP 12C.
Nice.
It was a cool tool.
Yeah.
Good old HPs. Yeah, them in Texas Instruments, right? Remember what they went?
The TI. Yeah.
Mm-hmm.
Yeah. Well, we're at 10:02. And I think we should go ahead and get started. So we're just going to make sure that we are indeed recording, and we are. So there we go. Don't want to have that happen, right? So we're going to go ahead and get started, guys. I want to thank everybody for showing up. Really appreciate you being here. And we're going to have on the call today, of course, we have Tom Hutchins. He is a Senior Vice President and Sales Manager over at Angel Oak. Tom, how are you doing today?
Doing great. Thank you, Frank.
Good, good, good. And of course, we have Barry Habib, CEO, founder of MBS Highway, and a whole bunch of other stuff. And Barry, how are you today?
I'm excited to be here with you and Tom, my friend.
Awesome. We're excited to have you here. So these guys, obviously, guys are heavyweights in the industry, been around a long time, and they have a lot of great knowledge to share. That's going to be very helpful for all of us on this webinar. By the end of this webinar, we'll certainly take some questions at the end. But by the end of it, I think you're going to walk away from this thing going, yeah, that's cool. I got something I can make use of today. Just as a little housekeeping, guys, as we go through the webinar, please feel free to ask questions. You should have a questions box up on your screen somewhere, a little icon from GoTo where you can pose questions to us. Go ahead and ask them, whatever they might be. Do not worry or panic if we don't get to your particular question at the end of the webinar, because at the end of the webinar, Angel Oak and Barry's team will get all of those questions. They'll get the spreadsheet of everybody who attended, and they'll get all those questions, and someone from their team will be able to reach out to you and answer your questions directly. And with that said, also, at the end of the webinar, we are recording it. By the end of the day today, we will have sent out the recorded version of this webinar to you via email, along with any assets or promotions that might be going down as well at the end of it. So Tom will probably be able to provide some of his PowerPoint, and Barry as well, possibly, or they'll be able to, whatever they want to pass along at the end of it, we'll be able to pass along to you guys, and you'll be getting it. So don't panic, but I would still encourage that you do take notes. Of course, if you take notes, things are going to get absorbed by you much better than just not doing that. And don't just rely on the recorded version to come to you at the end of the webinar, because GoToWebinar recordings sometimes do not work, and I've experienced that several times where everything should be fine and the recording is a flop. So it would pay to pay close attention to what's going on and ask
the
those
act
questions.
of taking notes increases retention by 3 times, like a 300% increase if you take notes.
There you go. So we want to take notes. Now, before I tee this up, I'm going to go ahead and launch a poll question, guys, and you'll be able to answer the question right from your screen. It's just going to pop up, and we're just all curious if you've closed any non-agency deals within the past 12 months. So when you see that poll question pop up, it'd be great if you could go ahead and answer that. And before we get started, I'm going to go ahead and tee up and kind of set the premise for this webinar. And I think what you're going to learn from this will apply not only to your scenarios that you'll wind up in when you're working non-agency deals, but also I think there's going to be a lot that you'll be able to pull from this that'll help you just in general with potential buyers that might be sitting on the fence. So with that, the thought process here is that when it comes to non-agency deals, oftentimes we're faced with a little bit higher interest rate. And so even though you might be able to find a loan that will work for a borrower in a particular scenario, sometimes when you present the loan product to the borrower, the rate can sometimes be an objection. And so we wanted to be able to work with you guys and show you guys, working with Barry here, how you can overcome that objection, because it actually is probably still the make sense deal for these guys to do, but you have to be able to display that properly. And that's what we're gonna show to you guys. And we're also gonna show you guys at the end, also, guys, where you can look to find these type of scenarios, where you can find these deals, which is always a big hit at the end. Barry, did you have something before I turn it over?
No, continue. I do have something to add. I'll wait till you're done.
I'm pretty much done. I'm just going to go ahead and turn it over to Tom here to go through some scenarios. But did you have something before I tee him up?
I do. I just want to set this up because, look, team, low-hanging fruit is less plentiful for sure. Forget low-hanging fruit is rolling around the floor. Rates are higher. They're going to go higher. Refinances have already swapped with purchases. As used to be 60% refinances, 40% purchases. That is exactly flip-flopped at 60% purchases. So, we have to be better at providing support for that real estate agent in closing more transactions for them. And I don't mean knowing how to put a deal together. That's the price of admission. You really have to be an advisor. You really have to understand how to articulate the opportunity in real estate and overcome some of the objections. And I think that today's focus on the call, while we're going to show you some specific things and real nuts and bolts and show you how to do it step by step, the understanding here is that you need to be an advisor. You need to close more of the opportunities you've been given, because everybody says, I want that extra deal. Wish I had that extra. You already have the extra deal. It's already in your hands. Just turn it from a transaction that you didn't do to one that you did do. Convert more of the opportunities that you already have in your hand. And I think that today's call is going to go a long way in helping you do that.
Awesome. Thanks, Barry.
I agree 100%, Barry. Well said.
Okay, great. Just to let everyone know, the poll is done, and 46% have indeed done a non-agency deal in the past 12 months, and 54% have not. Now, with that, I'm going to pass this over to Tom Hutchins. So what we're going to do, guys, is we're going to go and have Tom show us, let's see some real life scenarios that Angel Oak has been able to approve and figure out what those rates wound up being. And with that in mind, we'll then pass it back to Barry so we can take those rates that maybe are being objected to by the prospective borrower and have Barry dissect that and show us, look, it's, if it's advantageous to go ahead and go through with this transaction, even though the rate might be a little bit higher, and why.
So you're going to give me the hard part of overcoming the rate objection, huh?
Exactly. Yeah, you're getting the tough side of the deal.
Guys.
Yeah, we're gonna tee up Tom here to do the easy side, which is, look, we can do this. So then we're gonna pass it over to you. So Tom, I'm gonna go ahead and pass the screen over to you, and if you can bring up your side of it and walk us through a few scenarios, and we'll make note of what the interest rates were on those scenarios, and then we'll come back to Barry, and then we'll run those scenarios quickly through Barry and his MBS product to see how they might actually truthfully pan out for those prospective buyers. So take it away, Tom.
So just a quick housekeeping is, can you see my screen? And
yes.
See this PowerPoint. Okay. All right.
Looks beautiful.
Got past that. Very lovely. Okay. So all very good points. I think we're in an environment now that every deal has always mattered, but we really want to provide tools to help loan officers become that consultant, become that person that can help a borrower fix their situation, not just, hey, let's put them in an agency loan and move to the next deal. And I think what we're going to be able to show you today are ways to do that. And we get asked every day, just a little background on Angel Oak Mortgage Solutions. We are exclusively a wholesale and correspondent lender, only in the non-QM, non-agency space. We've been doing this almost 5 years exclusively now. So we've got a lot of experiences, and we've seen that when we show loan officers real live deals that have occurred, then people start to remember, oh yeah, I saw one of those 2 years ago or 6 months ago, or sometime in my past. And so that's really what we're going to do today. I'm going to show you some loans that we have closed, what they look like, and then show you how to work with Angel Oak and with the tools that we provide to make it easy. And then as Frank said, going to hand it over to Barry and talk about some other data that will help you become that consultant. So with that, let's look at a scenario. A big portion of the non-QM borrowers that we're seeing today are self-employed borrowers. So we had, this was last year, self-employed borrower, been self-employed for 8 years, but everyone knows one of the big advantages to being self-employed is you get to write off a significant part of your expenses and run those through your business. So oftentimes, and many of you on this call can probably relate, that once you see a tax return, you see that, gosh, their net income that they're showing and reporting to the IRS is not enough to support the loan that they want to get. So that's the scenario we have. We had a jumbo loan. This was a $750,000 purchase. The borrower wanted to put 25% down, but because of their net income, they were not going to qualify for this jumbo loan. So what I wanted to show you next, just changing screens quickly, is where you would go if you had this scenario. What do I do next? That's a question. Where do I go from here? And so if you could just, when you're taking these notes we talked about, is write down our website. It's very simple. It's angeloakms.com, angeloakmortgagesolutions.com, and everything that you need to get started on a non-agency loan is right here on our website. So save this, bookmark it, please, and then once you're at this site, it's very simple. We have a link right here, and we call it Quick Quote. And we call it that because that's what it is. It is simply a quick, scenario-driven tool that can let you know, is this something, do I have a chance on a loan like this? I've got this self-employed borrower. They have a 743 credit score, a $525,000 loan. Can we do this loan? And when you first log in here, it's going to ask you for the name of your company, and you just type that in once. And once you've done that, you're good to go. And then that'll also let you know if you're approved with us and things like that. So you start on the Quick Quote just by answering a few questions. First and foremost is the credit score. In this scenario we just talked about, they had a 743 credit score. Loan amount, we have just different ranges. So we'll say a jumbo loan, 453 to 750. If you recall, loan to value on this one was 75%. And then a housing history. What have they looked like for the last 12 to 24 months? And we'll say this borrower with their credit score has not had any housing issues recently. So you click that. The other piece was documentation, income documentation. So we have choices. We have a 12-month personal bank statement or a 24-month business bank statement, and either one would qualify for the same product. But you click that, and you can see what's changing down below are the products and programs that are available. So here we have two different products, a Platinum and a Portfolio Select, just very high level, very quick. Answer those few questions, and you've got what you need. And in this scenario, Platinum, the borrower would qualify. We asked for a 75%, but this actually tells you we could go to a 90% with no MI for this borrower. Gives you the rate, tells you a little bit about, you have to be, that borrower, if they did have some type of credit event, would need to be 4 years, either a bankruptcy or a housing event, and then just some other simple stuff like reserve requirements for this loan. So this is our Quick Quote. This is real simple. Barry, if we'll just kind of make note here, this is the 75% at 5 and an 8. So pretty simple. Then we were going to look at some other scenarios. Here's another one. Just so people understand, the non-agency that we are seeing the majority of fall into two really pretty big buckets. One, the first and the biggest bucket is a borrower who has some type of credit challenge. So their credit challenge could be a foreclosure, a bankruptcy, short sale, something that has not seasoned long enough from to qualify for an agency loan, or they just have credit challenges today. So those are the big buckets, credit challenge borrowers. The other big bucket is what we just looked at was a bank statement self-employed borrower. But here's a scenario where the borrower had some health issues. They had a Chapter 7 in 2014. They tried to keep their house through the process, but then in 2016 had a foreclosure. So bankruptcy followed by a foreclosure. The borrower did happen to have a 682 credit score, but we have a non-prime product that helped that borrower. And so you can see further, it was a $350,000 purchase price. We gave them an 80% loan, and something that we talk about, these are storied loans, and we manually underwrite every single loan, which allows us to make exceptions every single day. But the story with this that really made this a good loan for us is their new mortgage payment was going to be almost identical to the rent they had been paying since their foreclosure. So we were comfortable with this borrower. But if this is a scenario, you would do the same thing. You would just go to our quick quote, and we can. This is live, and as you make changes, the scenario itself will change. So I think that one we had a 680 credit score. So you change that. Our loan amount was a little bit lower, so we'll change that bucket. LTV, we said 80%, and the income on this one was a full doc. So here, different products. We've got 80%, and the names of these programs don't really matter, but this is where some of the details do matter. The housing event seasoning, if you recall, that borrower situation was they had a foreclosure in 2016. So that was less than 24 months when we originated this loan. So here's a 24-month seasoning, bankruptcy 12 months, so that they would fall into our non-prime program. Non-prime, it's a 7 1/8 rate at 80%. We can, as you can see again on all these, we can, for this borrower, we could go to 90% loan to value in total. So again, very simple, very quick. You can change different parts of the scenario and get an answer right there.
Hey, Tom, may I just,
yeah.
I just want to set the stage here for a minute here, is in that what you're actually doing here, and we talked about higher rates in this particular case. I think you mentioned 5.125 rate.
Yeah, this one was a little higher. It was even 7 1/8.
Pardon me.
Yes.
Excuse me. 7.125 rate. So, Tom, when someone hears that, and they know that rates are, closer to 5% or whatever, 4 3/4. Let's just say they're even under the assumption that rates haven't done what they've done of late, and they're saying, okay, well, I know that rates are whatever 4%, even though we know they're closer to 5. It's not a question of getting 4% or getting 7%. Everybody would rather have 4%. That's an obvious choice, but that's not the choice here, and that's what a good salesperson. So if you're listening here, I mean, one of the best sales lessons that we can have is understanding what's on the table here. Is the customer does not have the choice of 4% because they don't meet those parameters, so they're just not able to get that interest rate. If the choice is as follows: either you buy the home or you don't buy the home. So maybe you potentially wait. It's not like you can get 4% and we're trying to sell you 7. No, we're not trying to do it. You can't get 4%. The only rate you can get is 7. So it's either 7 or you have to rent, or you have to wait and rent, or do whatever. But you can't buy the home. And now if we can get their mind around that, then the decision comes down to, well, is that a good decision to buy the home even with a 7% rate? And what would I be missing out on? And if we could frame it that way, then we have a much better chance of presenting our case to help both the realtor, to help ourselves, but truly to help the customer create some wealth, to see if it still makes sense.
Absolutely. No, you're exactly right, Barry. It is not 7% or 4. It is 7% or nothing, or remain where you are and keep renting. And I'm excited what we're going to do next when I hand this back over to you, so we can plug these numbers in and see how they work in different markets around the country. So anyway, here's another scenario. Borrower, 704 FICO. They had a foreclosure 4 years ago, and they were buying about a $700,000 property, and only wanted to put 10% down. So, it's just over a $600,000 loan. And some of the scenarios I'd already shown you, we can go up to these 90%. And something to note is that on all of our loans, mortgage insurance is not required. So people can really minimize the amount of down payment and closing costs that they're having to expose themselves to, hang on to that cash and still get a good loan and not pay that mortgage insurance. So we would do the same thing. Let's just go back here. This one we had a 704 score, I believe it was, $600,000 loan. So you just change the loan parameters, a 90% loan, and as you can see, it changes as we go. So here we are, Platinum program. They were 4 years from their foreclosure, so they have recovered during that period. Credit scores over 700. and we would be at the 90% and the 5.99. So again, not 5%, but 5.99 gets them into that home today. So pretty good stuff. If you just remember anything, this quick quote tool, you don't even have to be approved with Angel Oak to have access to it. You just put your company name in, and we'll do a little check to see if you are approved. If you are not approved, you can still use this tool. And just if I could, while I'm here very quickly, right here it says pre-qualification request. So if you ran this scenario, it looks like something you want to move forward with, you would simply click this link, and it takes you to another page where you select your account executive. We have every account executive we have listed here. Fill out a little bit of information about yourself, a little bit about the deal, and then you actually upload a 1008, a 1003, and a credit report, and that goes directly to the account executive, and they'll provide a pre-qual back to you within 24 hours. And we're gonna look at that borrower's scenario and get back to you with a solid pre-qual of what loan we can do for that borrower, and then you can keep the process going. So you would hit submit right here, and you're off to the races.
So Tom, real quick, on your, just wanted to point out too that you guys do a lot of jumbo stuff, isn't that the case? Because the jumbo loans
Absolutely.
are typically pretty persnickety. It's pretty, jumbo money is not necessarily the easiest money to get, and so a lot of that kind of falls off the table into your lap, doesn't it?
Just missed jumbo is huge, and that's within the two big buckets that I talked about earlier. Even borrowers, the self-employed borrowers, our average loan amount is actually over $500,000 on our bank statement loans.
Interesting.
So jumbo money for the self-employed borrowers, and then jumbo loans for the borrowers that have had a credit issue, because the prime jumbo, you have to have pretty pristine credit for 7 years, and not many hiccups are allowed. So yes, jumbo loans, we this platinum program, in fact, I've mentioned a couple times, we'll do a 90% loan up to a $2.5 million loan amount with no MI. So, and you don't have to be 4 years from a foreclosure. So jumbo is a big part of it for sure.
Guys, just a reminder again, Barry kind of opened this up saying, the low hanging fruit obviously is sparse at this point, and we got to dig up more deals. And there's a lot of these deals out there to be had. It's just a matter of knowing where to look, how to find them, how to market for them. We're going to touch base on all that too, right at the end after we hand this off to Barry and let him work up some scenarios for us and see how this all plays out. So just please stick around to the end, because you're going to want to make sure you know how to actually go out and find this business, which is a big key to this whole puzzle. Are we ready to go to Barry at this point, Tom, or did we?
Yeah, I believe so. I mean, unless you see any questions from anybody, Frank, that we would need to address, or what have you.
I think for the sake of just moving forward, we'll deal with the questions at the end, if that's okay. Then we can just kind of tackle them all at one time. But again, with that said, please, guys, do put your questions in. Fire them in there. We're going to get to as many as we can. And remember, if we don't answer it on the show, don't worry, because they will be followed up with either by Tom's office or Barry's office, depending on what the question is. So with that, I think what we will do is we will go over and hand this off to Mr. Habib. Are you ready for us, Barry?
I'm ready. So Tom outlined some really, really good points and some good scenarios, and obviously very easy to utilize this. So I was just watching how quick and easy it was to get this accomplished, and I couldn't help but just remember, my days of originating, which we had at the time. We thought we were kind of easy to use tools, but certainly nowhere near as easy as this is to put things together. So look, I'm going to kind of use some round numbers here and do some things. I was putting in some of these as you were going, Tom. So you brought up a few scenarios. So we have our MBS Highway buy versus rent comparison tool. It's nothing like it at all. I mean, people say we got a buy versus rent tool, but nothing like this. So what's our objective here? Look, you guys want to make more business happen. You want to make more rain happen. You want to get more ins in real estate agencies. You want to endear yourself to those realtors. You want to increase your income. You want to put more money on the table for yourself, for your family, increase your production. I mean, this is what you want to do, obviously. So by now helping real estate agents who have these customers that aren't having a difficult time qualifying and saying, hey, we can get you qualified, but not only can we get you qualified, if it is an interest rate that the customer is balking at, we can show the customer why this makes sense. And obviously, as you see this, you can imagine you competing with another company, even if the interest rate were even more attractive, how much easier it would be for you to help that real estate agent. So I put in a $700,000 loan here to start with. And then our calculator says, okay, where are you? Because we have data, forecasts, and historical data on appreciation for every single county and every single MSA in the United States. Every single one. The data is absolutely amazing. So when you take a look and you say, okay, let's say we're in New Jersey, Hudson County. I'll go around the country in some places too, so that you could see this. New Jersey, Hudson County. It's a beautiful place. $700,000 home. So we know what the cost per square foot is in every single county. And in Hudson County, it's $357 a square foot. So we could tell you, or we could tell approximately how many square feet this is. You're talking about roughly a 2,000 square foot home. We also know the cost to rent per square foot in every county of the United States. So in Hudson County, we know that a comparable rent would be $3,843 a month. That's what a comparable rent would be. Now, you could override this and you could put any number in there. So let's just stick with that for a second. And if they've got some renter's insurance, let's say, okay, it's $30 a month in renter's insurance. And now what we have to remember is that rent's going to go up over time. The national average for rental increases is 4% per year, according to the Consumer Price Index report. However, we also know what it is in Hudson County. It's only 3%. So we're not going to go with the national average. We're going to go with what it actually is. Now, if they buy this home, in this case, it's a $700,000 home. And the first scenario that we looked at, Tom, was with a rate of 5.125 at a 75 LTV. Am I right on that first scenario?
That is correct. Right on.
Okay. So, you can easily put the numbers in here. Once you put that on, it's a 30-year fix. Let's say $10,000 in closing costs. We have what the taxes are for every county in the United States. So we know what the tax rates are. If it's any difference or variance, you can put that in there. And yeah, in Hudson County, New Jersey, this home's got $15,000 plus per year taxes. I know some of you listening to this are saying, what? Yeah, welcome to New Jersey, guys. So mortgage insurance, if there's mortgage insurance, we have a way for you to put that in there. But in this particular case, Tom, the wonderful thing about working with you is there is no mortgage insurance, correct?
No
MI
on any of these loans. Right.
Even if we, in the scenarios that had a 90 LTV, there's no mortgage insurance, right?
That is correct.
And folks, you know what the cost per MI is if your FICO scores are like in the 600s or lower than that Tom could still get done for you. So just the MI alone counteracts at least 1% of the interest rate or so. So just think about those things as you move through this, okay? Homeowners insurance, that's about $100 a month. And then here's an interesting one. How about maintenance and repair? So let's say there's no maintenance fee on this home, but shouldn't we be honest with the customer and tell them, listen, if you're renting, you're not going to have repair costs. But if you own the home, let's give you what those repair costs are going to be. So, hey, we're telling them something bad here. We're trying to tell them what to be careful of. We're not trying to sell you. We're trying to make sure that this makes sense for you. And so what we'll take a look at here is the maintenance would be, in this particular case, the repairs, we put $2,000 a year, but what if you wanted to put $3,000 a year? Okay, that's pretty high, $250 a month in repair costs. Probably not going to have that, but anyway. Then there's the cost to sell the home. You see, when you're renting, if you stay there for several years, let's say they stay there for 9 years and now you want to leave, you just say goodbye, thanks, my lease is up. But if you own the home for 9 years and you want to leave, you've got to get, in most cases, you've got to get a way to sell that home probably through a real estate agent, and which means you might incur a cost of 6%. So let's put that in there. Wow, 6%, that's going to be a lot of money. Yes, it sure is. And then we take a look at some of the other things, just to recap. If they're going to be there 9 years, they're in New Jersey, Hudson County. We know the historical appreciation is for the past 43 years has averaged 4.72, but the forecasted appreciation per year compounded for the next 9 years is 5.38%. It's a very strong market. So we put that in there. And then we want to put in what your tax deduction is. So you need a tax rate. Well, fortunately, we have the tax tables. If their income combined, let's say that he made 85, she made 85, so they made a combined 170. They're in the 24% tax bracket. We'll put that in there. And then what's your filing status? Is it single? Is it a head of household? Is it married filing jointly? And the reason that we want to do that is because so many people make a mistake. Oh yeah, the interest is tax deductible, or this is a tax deductible closing cost, whatever. You've got to be real careful today. Under the new tax laws, we don't want to say these things unless we're sure. And the reason is because the standard deduction has increased. Meaning, if you're renting, you're going to get, and you're single, a $12,000 per year standard deduction. So we only want to show you the tax benefit over that standard deduction. Now, as you can see here, if you were single, it'd be $49,000. But if they're married, their standard deduction is $24,000. So much less of a tax deduction over the life of this loan. So heck, we want to give them the right numbers. Now, if they were to buy this home versus rent the home with this higher interest rate, their monthly payment would be about $600 and change a month more to buy and rent versus rent. So somebody might say 600 and change more. Maybe I should just rent. That's a lot cheaper, right? Well, watch this purple line, because just that 3% increase in rents going up per year in Hudson County, specific to the county, you could see that it'll eventually eclipse it. And over the life of the loan, 9 years later, yeah, it's a little bit more expensive in this particular case to buy versus rent, but by $15,000. Now, Tom, here's why we want to show them the opportunity, because at 5.38%, that $700,000 home be worth $1.121 million, giving them an appreciation of $421,000. Now, let's remember that if you live in this home 2 out of the last 5 years before you sell it and you're married, that's completely tax-free, okay? Completely tax-free. Where are you going to get that kind of tax-free return? And here's the best kept secret in the mortgage business. Folks, I don't understand why people in the industry do not talk about this. But if your principal and interest is $2,859, we all know the interest portion of it goes to where? That goes to the lender, right? We all know that. Where does the principal go to? It's your own money, Mr. or Ms. Borrower. So why are you guys keeping it a secret from them? Why are you not telling them that it's their own money? Essentially, you're writing a check from your checking account, you're giving it to the mortgage lender, and the principal portion, the mortgage lender is putting it in a guaranteed forced savings account that's going to amount to how much? $84,000 tax-free. $84,000. And then you get your tax deduction. Would it surprise you that the net gain by buying this home is $436,000 versus renting the home? That's incredible. Highly powerful. And wait a minute, what about, now I know, Tom, we said that the rate on this was 5.125, which is a great deal. What if the rate was, let's say, 6.125? We're just going to play with some numbers here. 6.125. Okay, so I only made $400,000. Is that a bad deal? What if the rate's 7%? Okay. What if the rate's 7%, Tom? Oh, 7% is too high. You're only going to make $369,000 on this home. Look, folks, we could choose to be salesmen or we could choose to be advisors. And you ask anybody in the mortgage business, are you a salesperson or an advisor? Everybody's going to say, I'm a salesperson. You know what I'm going to say? BS. BS. How are you an advisor? Okay? How are you an advisor in this particular situation? Because everybody's going to say they're an advisor, is what I wanted to say. They consider themselves to be in a position of an advisory role simply because they know how to put a loan together. That doesn't make you an advisor. That's the price of admission. Hey, folks, do you remember when travel agents were on every single corner? You ask a millennial. If a millennial's listening, they're going to say, what's a travel agent? That's exactly the point, okay? What's a travel agent? Today we say, what's a travel agent? But back when, baby boomers or Generation Xers can remember, they were on every street corner. And now they're extinct. Why? They're extinct because they weren't advisors. They were information gatherers. And information today is very easy to get, and it's everywhere. Who saw, if you're listening, who saw the Rocket Mortgage commercial for the Super Bowl with Keegan-Michael Key? It was brilliant. But if you watch the commercial, let me ask you this, did it piss you off? Because it should have. It made mortgage professionals look like bumbling idiots. And what we really need to understand is that when in the Rocket Mortgage commercial, when they show on his phone, he goes, no, please, essentially tells him, puts up the hand, tells him to stop talking. He says, and he points his phone, this will take care of it because we don't need you. And what you have to remember is that it's technology every single day trying to make you extinct. How do we continue to be relevant? by explaining and articulating the financial opportunity, by showing them that through Angel Oak programs like this, you can still help that realtor and help that customer create this kind of wealth simply by understanding how it works. So let's use another scenario that you talked about. And I kind of preloaded some, and this time I went to Illinois. We're going to go around the country, okay? So we'll start heading west. But you can go to Cook County, Illinois, and you use like a $350,000 scenario. And we know in Cook County, Illinois, that would be roughly $26.69 a month for rent. Also going up at 3% a year. We put $30 in there for renter's insurance. So in this particular case, you've got a 75 LTV. We put 7.125 as the rate. And we've got closing costs and taxes already, and there's no MI, and same kind of situation, guys, that we went through. Okay, so we're going to go through this quickly. Cook County's forecasted appreciation a little lower than the historical at 3.35%. Somebody might say 3.35%. That's not very exciting, is it? Well, yeah, it's $155,000 that you gain. Is there anything wrong with that? By the way, all these count the cost to sell. Okay, if we go back to that other one in Hudson County, cost to sell $67,000 realtor commission. We're counting that, guys, and you're still coming up in this case $369,000, and that's at a rate of 7%. Tom said he was going to get your rate on this one of 5.125%. So we need to open our eyes and look and listen to these opportunities and scenarios. Now, I want to show you another tool that you can use, because maybe you're going to have a customer that's going to say, hey, you know what? I'm in a position right now where I think in the next year or two, I could fix my credit. So I don't have to take out that 7+% loan. Now, you could relate to this. You probably have seen some customers, maybe their credit's not that great and their MI cost is really big. So they might be paying $300 or $400 in MI. And they say, well, you know what? I don't want to pay that $300 or $400 a month in MI or the heavy MI cost. I'm going to wait and save up 20%, and I'll be able to go ahead and get a better rate. Or in this particular case, I want to fix my credit over the next couple of years. So it'll take me a while. And look, maybe it's not their fault. Maybe they went through a nasty divorce. Maybe certain things happen. Maybe, God forbid, there was an illness. And they really feel that they can get back on their feet, reestablish good, strong credit, and get the best rates that are out there. Here's the problem, everybody, that we have to explain. People think that while they're fixing their issue, the world freezes and stops in time. What you got to show them is that the world is spinning and moving, and things are happening and things are changing while they're doing it. So we have to explain to them what could happen by waiting, by looking at the cost to wait. So we go into a tool that we have in MBS Highway. That was our buy versus rent tool. We go into this loan advisor tool. And in this loan advisor tool, we're going to do this example for Angel Oak. Let's just go back to that $700,000 home. Let's say the property taxes. We picked Los Angeles County, California in this one. As I said, we'll start heading west here. Monthly homeowners insurance here. And now what we have is let's take a look at a scenario. We have an original loan where we have a 30-year fixed rate loan with 0 points at 6%. Just to pick a round number. I think, Tom, the rate that you were offering on this scenario was 5.99, if I'm not mistaken. 5.99. Yeah, so I just rounded up to 6% here. So, but it'll be actually be a little bit less, right? So I'm going to put that in there and just edit the scenario here we can actually put the 5.999. We can do that and update this. So that's fine. And then what we have here is we have, if they waited 1 year, we want to take a look at what would happen if they wait 1 year. They think that they could get a lower rate of 5%. If they wait 2 years, they still think they could get the best rates out there, 5%. 3 years, the best rate at 5%. So they feel that by waiting, they could fix up their credit and they can make this all happen. So here's the problem with that. You see, in Los Angeles County, that home that's $700,000 today, their forecasted appreciation over the next 1 year is 7.07%, 2 years 13.1%, 3 years 18.61%. Look what it does to the purchase price of that home. Look how much more expensive it is. And if they want to keep the same 90 LTV, look how much more expensive that it gets. And here's the real magic, team, is that if you were to do this loan with Angel Oak's program, there is no mortgage insurance. If they waited a year, fixed up their credit, the rate went from 7 to 5, they'd have to pay mortgage insurance on that, okay? So when we take a look at what this would mean is that, okay, let's say congratulations, you waited 1 year. Your interest rate went from 7% to 5%. By the way, that's if rates don't go above 5% a year from now. I believe strongly that they will. $137 a month is your savings. Congratulations, you did great. That includes the cost of MI, but you've lost in property appreciation $49,000 and in amortization. So everybody forgets amortization, right? Best kept secret, $7,700. You lost $57,000 to save $137. I mean, I'm sorry, it'll still cost you $137 a month more. If you wait 2 years, look at the difference. 3 years, look at the difference. And if you wanted to see it graphically, you could see what the monthly increase would be and what it would be in lost amortization and appreciation. Hey, let's play with this for a minute here. So that was a rate of 5.99. Let's change it. What if we made the rate on this 7%? Let's update that. And here's what you see. If the rate was indeed going from 7%, you would be saving $278 a month if you waited a year, but you'd lose $55,000. If you waited 2 years, you'd lose $47,000. If you waited 3 years, you would actually be paying more on that loan. So this illustrates to you how much better it would be if you were to make the purchase today, even with the higher rate. And we could put in a scenario here. I've just got kind of an open slate here that I did. And if we have time, if you'd like to, Frank and Tom, we could open up some questions there to see, maybe somebody could put in an area around the country that they're in, that we could kind of take a look at some of these variables and show them the actual cost of waiting on a scenario that they're thinking of. So if that's okay with you, we can have them post some scenarios in there that they would like us to examine together, Tom.
Yeah, Barry, why don't you try like King County, Washington?
Let's do it.
Yep.
So we'll go to Washington, and let's go to King County. Hold on one second, guys. I have to refresh this page. Pardon me. My Washington and King County. There you go. Okay, I got it. We'll do this for Angel Oak. And let's take a look at a purchase price there. So it's kind of expensive there. Let's just say it's, we'll pick a number of 600,000. How's that sound? And let's just say $7,000 in property taxes and $100 for homeowners insurance every month. So now that we have that, let's continue. And on this loan, it's going to be a 30-year fixed product, Tom?
Sure. Yes.
And what would the rate be on that? Let's go with a high rate, Tom. Let's just say that they've got a tough situation credit-wise.
Say 7.5.
7.5. Okay. And 7.5%. Would that be with points? 2 points, let's just say.
Yeah, put in a couple points.
Okay.
Sure. Do that.
So, folks, you're listening. 7.5%, 2 points. Customer might say that's a deal breaker right there, right? I'm not going to do that. I'm going to wait a year, and if I wait a year, I'll then be able to get a lower rate. So let's put in the rest of the details. So we said that in this particular case, the interest rate was going to be 7.5%, 2 points, and the down payment on this, Tom, what LTV are we looking at?
Run a 90.
Let's run a 90.
10% down.
So we're going to run a 90 LTV. There's no mortgage insurance with you, right, Tom? I mean, they would have mortgage insurance, assuming their credit wasn't that great. Their mortgage insurance would normally be like $473 a month, but they don't have that with you, right? So they're going to save that cost of MI. Not even counting that or considering that. Let's just put in $10,000 for closing costs as a placeholder there. So now, when we take a look at this and we say, okay, let's take a look at the cost of waiting on this. So if we waited for each year, let's go edit this now. If we waited 1 year, let's assume they can get a rate of 5% if they waited 1 year, right? Everything else remains the same. If they wait 2 years, also they think they can get 5%, or you know what? Let's say it's a year and a half. We'll adjust that. Say it's a year and a half down the road, and the rate that they think that they can get is 5%. So we'll put that in there. And let's say that either 2.5 or 3, let's say 2.5 years down the road, they also think they can get a rate of 5%. They don't think rates are going to move. They think rates are going to stay around right where they are right now. And I don't want to pay this 7%. So let's take a look and see where we are. So now remember, one of the things that we're going to take a look at here is the fact that if they did this, they're going to have mortgage insurance, right? Because we're going to keep the LTV the same at a 90 LTV. So that means if they got a conventional loan at 5%, they've got to get conventional MI. So let's add that in. So if they waited 1 year, what we're going to do is we're going to say, okay, if you were to add monthly mortgage insurance, and let's just say they improved their credit to, let's just say, a 700, we'll use that $269 for MI there. And here, same thing. Let's go and let's edit this. Let's include the mortgage insurance out of 700 FICO. And then finally, let's do it in the last scenario. Let's include the mortgage insurance out of 700 FICO. So now we're giving a fair comparison between the three. So let's just take a look. What will happen to the home value? Well, King County, Washington, the forecasted appreciation for the next year is 3.88%, which means that home today for 600 would be worth 623. And cumulatively over 2 years, it's 5.21%. 631 would be the value. In 3 years, it'd be about 8% or 647. So you're going to have your 90 LTVs, and you're going to need a little more money for down payment, and you're able to go from a 7.5% rate today to 5.55, but you do have to pay some MI. You're not paying that with the loan at Angel Oak. So what's the bottom line? So if you waited 1 year, you would save $473 a month. Wonderful. That's going from a crazy change in interest rate, which we know the rate's going to be higher here, but still, and say at a super high rate, Tom. But the problem is, to save that, it costs you $28,000 in appreciation and amortization. If you wait a year and a half, you could see the same kind of situation, except worse. If you wait 2.5 years, you could see the same thing and worse. And then you could show them that on the graph as to the difference in cash flow. But Tom, the thing of it is that that rate today would probably be less than that, wouldn't it? We kind of went crazy with that. What would the rate realistically be closer to?
Closer to 6.
Okay, let's even say 6.5%, right? So if we said 6.5% and updated it with that on the original loan, and let's just say they waited instead of a year, 2 years to really fix their credit, right? And instead of 2.5 years, let's just say they waited 3 years to really fix their credit and update that. Now here's what we've got. You'd save in the first year $110 a month, but it costs you $29,000. And then over the next couple of years, it would be ridiculously more a month that you would spend $767 a month more if you waited 2 years, and $1,051. And guys, that's, oh, you know what? Forgive me. I have to make a change here. Pardon me. I have to edit the interest rate to a 5% interest rate. We didn't do that. Let's go 5% here and update that. And let's go 5% here and update that. We have to put the change in rate into the low rates that there are.
And again, that's assuming that rates don't go up over the next 2 to 3 years, right, Barry?
Exactly right. So you could see here the huge amounts of money that they would have lost for the small amount of money that they would gain in order to do this. So this is absolutely a home run if they were to do this. And by the way, I could see here I didn't put the mortgage insurance in. So if I put the mortgage insurance in for years 2 and 3, that's going to really make a big difference as well to show. And let's quickly do that because I want to show with the mortgage insurance in there as well. And let's update that. And now you could see that, look, if you wait 1 year, you would wind up saving $110 a month, but you'd lose $29,000. If you wait 2 years, you'd save $18 a month, but you'd lose $51,000 in amortization and appreciation. And if you waited 3 years, you'd actually pay $78 a month more, and you'd lose $75,000 between appreciation and amortization. And here's why. To keep that same 90 LTV on the increased value, you've got to borrow more money. And even though you're borrowing it at 5%, because you're borrowing more money and you're adding the MI, the differences are minimal. This is a wonderful tool that could show you how to help your customers see this opportunity and benefit of using Angel Oak's process.
So this is amazing, by the way, and I just want to let you guys know that there's a lot of people chiming in, Barry, going, oh my God, I want this tool. What is this tool? So, you know, obviously, guys, we're going to give you access to MBS Highway at the end of the webinar. Barry's even going to cut you a really great deal on it. It's already extremely reasonable. Somebody asked how much it is. Like the most reasonably priced thing I've ever seen in my life with what you get. But we'll get to that stuff at the end. It is close to the top of the hour, Barry and Tom, so I do kind of want to push things along. But before I pass it back to Tom, where he can show us quickly, Tom, you're going to have to show us where we can find these non-agency deals. We do have a scenario, a real scenario, Barry, that someone would like to do the old comparo on here.
Where is it first?
Well, we have to. Yeah, we got to figure out. I got to ask Rami what county it's in. I don't see, he didn't put it in. But Rami, if you could tell us what county you're in. Okay, he's in Los Angeles. It's in Los Angeles.
Los Angeles County.
Yes,
okay.
And this is for you too as well, Tom. The purchase price is $900,000. It's an 80% loan to value deal. And so,
here's, by the way, here's a look at Los Angeles County in the real estate report card. It is super strong. The forecasted 1 year appreciation over the next 5 years, it's great. And I think, Tom, what you wanted to kind of show was, you know, what is the growth of that over time, right? You wanted to show like an appreciation over time, Tom. You wanted to take a look at, I believe.
Yeah, absolutely.
Okay, so let's put in this scenario first, and they wanted to do a buy versus rent or a cost of waiting.
Well, this is a cost of waiting. So, Tom, what it is it's a 80% at 900 if you can get a quick rate, and the FICO is 760. They had a foreclosure 2 years ago.
Okay, so what's the loan amount? I mean, purchase value of the home?
900.
Okay.
And what was the
LTV?
Yeah.
So the property tax is going to be about $7,500.
Okay.
$100 a month for home insurance, and it is in California, and it is in Los Angeles County. You said, right?
Yes.
Let's continue. Okay. So what's our loan that we're going to give them, Tom? 30-year fixed?
Frank, real quickly again, what was the credit score? I'm over here just running a quick look. Credit score of what?
760.
760. Okay.
And Frank, what's the down payment?
80%, 20% down.
Okay.
20% down, and a foreclosure a couple of years ago?
Yeah, 2 years ago.
Okay. We would be at an 80 at a 5 point, with that foreclosure being 2 years ago, 5.375.
5.37. This is going to be too easy, guys. 5.375. How 2 points?
I put a couple points in there,
let's make it hard. Why don't you? I know you can get him 5.375, but what you want to just show him what it would be if it was 6.375? It's too easy at 5.375.
Well, you know what? I'd say do it at 5.375. This is a real scenario for this guy.
All right, here we go. Let's do it. Let's show the analysis, and now let's do the cost of waiting. Here you go. That $900,000 home in 1 year, here's your value. In 2 years, here's your value. In 3 years, here's your value. So to keep an 80 LTV, this is how much more money you have to borrow. And this is what the Mortgage Bankers Association says the relative change in interest rates would be. But if they wait a year, what rate do you think they get, Frank? Do you think they're thinking they're going to get 5%?
Well, this is a big old jumbo loan. Yeah, I don't even know.
Let's be kind. Let's say that you can get 5%, okay? And let's say that this guy is really crazy and he thinks the rates are going to drop to 4.5% 3 years from now, okay? So let's put that in there. And we've updated it. We recalculated here. And what you see is that, I mean, if you wait 1 year, okay, it's going to cost you $151 a month more. If you wait 2 years, it's going to cost you $421 a month more. If you wait 3 years, it's going to cost you $411 a month more. And that's getting a rate of 4.5%. But look at how much money you would have lost.
Yeah, fix the taxes, Barry. That the taxes are going to be $11,250 per year. It's still going to be amazing. So
Well, it doesn't have a bearing on anything because the relative change is still the same. Yeah.
Because you're going to pay that every year.
Taxes are
You're
taxes.
right.
So anyway, guys, we are really bumping our time frames on this. This is amazing, and that live scenario was fabulous. Most of the questions are basically, I love this tool. I want to get my hands on it, but I would really like to, if it's okay with you guys, shift over to Tom so these guys can get a feel for where they can go out and find this business real quick. Is that okay?
Absolutely, Tom.
Let's do it.
Take it away.
Let me shift it over to you, Tom. Hang on real quick here.
Where can you find more of these borrowers? Yeah, that's what we get asked a lot because everyone kind of is starting to understand over the last few years what non-QM means. Now we've shown you a tool that you can actually put some real loan scenarios in, and then you can use Barry's tool to see what kind of return you can expect, even if you're not getting a Fannie Mae or government rate. But where are these borrowers? It's very interesting, some statistics that a lot of people do not know, but half of the United States borrowers out there or potential borrowers have a credit score. Half the population has a credit score under 680. And when you start talking about, we've already talked about jumbo loans. Getting jumbo loans when you get under a 680 gets really difficult. So we're talking about half of the population is going to fall under that. And then when you go even further down the credit spectrum, a third of the population has a credit score under 620. And the loan choices get extremely narrow when you get below a 620. So, if you're out there and Barry's talked about the low-hanging fruit, but if you're not even looking at half the trees if you're not participating in these non-agency or the non-agency space. So those are just some important things to remember. But where do you go find these borrowers? And I think it's obviously realtors. Realtors know these self-employed borrowers. They know these borrowers who've had a life event, a credit event. Let them know that these products and these programs are available for them today. I would always revisit any turn downs that you've seen in the last 12 months. Pull those guys back up and see if maybe now today with the products and programs that are out there that can you salvage those deals. Builders and developers, builders do not want to lose any potential borrower that goes through a model home or wants to build a home. They want to capture them. So you can have some tools now to capture those borrowers. Accountants, we talked about significant write-offs. Who is it that's writing these taxes and creating this lower net income? It's the accountants. So they know the self-employed borrowers that are very good borrowers and very good potential borrowers, but they're very good at being accountants. So their net income that they're showing are not going to qualify for the loans that they want to qualify for. Obviously, financial planners, bankruptcy attorneys. Another one that I only see on our list that we talk about a lot is other loan officers that perhaps they work with one of the big banks that are not going to offer anything outside of the agency and government boxes. Go to those loan officers and say, listen, I don't want to take your referral source, but I would like to help your borrowers and be that resource. So really just kind of networking. I know we're running out of time. We have lots of tools on our website from a marketing standpoint that you can create flyers and videos and different things around this non-agency space to kind of help you surface these borrowers and expand your network.
It's great stuff, Tom.
Yeah,
it's great stuff.
The one thing that always stands out to me about that is the the local banks that like here I've got First Northern Bank, you know what I mean, Travis Federal Credit Union. These guys are straight vanilla, straight A, Fannie Freddie, you know what I mean, end of story.
Nothing
That's
else.
all they do. And if you go and call on those guys and go, give me your crazy stuff, give me stuff you have no chance of doing, and I'll take care of you. You know what I mean? I think you'd be surprised at how many guys would go ahead and send you some deals because they got, they're dealing with the bank customers that come in every day, And, they're like, hey, I need a mortgage. And there's a sign here. It says, we do mortgages. And they're going to go and sit down, and the guy's going to say, yeah, I can't do you. You know what I mean? It would be a lot better for him to be able to say, but I know a guy who can, right? And be able to hand them off to you. So, I mean, just all of it's good stuff. So let's go ahead and look at a couple of questions real fast, although I think that we're not going to have a whole lot of time to get to a lot of them. But guys, I just want you to know, don't panic. We will definitely get to you. Yes, they're asking how they can get MBS. Okay. Will Angel Oak.
Rob, call our. I'm sorry, Frank. Call our office at 732-526-7900, and
the number's on everybody's screen, Barry.
Great, there you go. Mention Angel Oak, and thanks, Tom. Mention Angel Oak, and you will get a $100 off voucher.
We'll be sure to have that on the email that follows up. But here's a great question, Tom. You ready for one?
Okay. Absolutely. Fire away.
And by the way, I just want to thank David Harding for this question because it's just a great one. So will Angel Oak do a loan for a business owner? Let's start there. And the answer is absolutely. Okay. Of a marijuana shop.
of a marijuana shop. One of the things that we don't have a problem with that business. One of the challenges is the banking side, federal regulations. That's the challenge that we found is the bank statement loans that we talked about. We have to see a cash flow going into someone's either business account or personal account. And what we've seen thus far is that's hard for someone that owns that type of business to provide. So, our loans do require that we have a documented ability to repay. And for these self-employed borrowers, it's their bank statement. So yes, but hard to do because of the banking situation.
So in other words, Angel Oak ain't got no problem with it, but others do. Let's take one more. It's at the top of the hour. But again, guys, don't panic if we don't get your questions. They'll get answered. Angel Oak will give you a call. Let's see. Let me find a good one here. Let's see. Really, it's just there's really nothing. Everybody's just shouting out what counties to try it in. We already covered that. Where can I get the tool? Yeah, I mean, really, guys, it's just going to be. You guys are going to have to, Barry, maybe even your team. You'll get the questions as well. There's a couple of questions in there for your team, Barry, but nothing that I think we really need to tend to right now. I think it all went really, really well. And just one last conversion, or one last one. How about condo conversions, Tom? Condo conversions, okay?
Yeah, non-warrantable condos are available on all of our programs. So.
Okay, great.
Get with a specific account executive on.
Okay, and then Barry, they are asking just how much is MBS normally? They know they get the $100 off, but how much?
If they wanted to do it based upon this call with the loan advisor, there's so many different things we have. We have a screen share, we've got loan advisor, we've got open house kits. So it all depends on what tools that they want. So just give us a call. We'll give you a walkthrough, and you can pick and choose the tools that you want to add to. It's extremely inexpensive. Put it this way: if you did one loan from it, it'll pay for itself for the next 5 years. So, awesome. Don't worry about the cost of it. You got to beat your clients. So you got to help your clients beat your competition.
And just so you guys know, I already know it's when you hear it, you're going to be like, oh, that's no brainer. It's not. It's the most reasonably
well,
priced.
I think everyone saw today that this kind of information is going to help them capture loans by being that consultant.
Yeah, people always tell me it's the only tool that I could dazzle a realtor and a customer in less than 2 minutes and do it right from my phone. And we give you so much. Just it's best if you just take a call, give a look, because I hate to just quote price without showing value. Sure. None of us should do that, right? So
yeah. All right, no issues with that. I'm just sending this to everybody in the group right now, real quick. Okay, send to all. That way everybody's got that. So they've got that. You guys will be getting an email that'll have that information on it as well. We'll have some assets for you from the presentation. Your questions will get answered by the appropriate people. We thank you very much, everybody, for showing up. And I want to thank Tom and Barry for being here on this webinar. It's always a pleasure to work with you guys and do these types of things.
Yep. Enjoyed it. Thank you, Barry. Thank you, Frank.
Thanks, guys. Bye.
All right. We're going to sign off, and we'll catch you guys later from the National Real Estate Post. Adios.
Bye.
Bye-bye.